Eli Lilly is dropping $3.5 billion on a new 925,000 square foot pharmaceutical manufacturing campus in Pennsylvania's Lehigh Valley, the largest project in the region's history. But why there? It seems kind of random, doesn't it? Well, to understand the decision, we need to understand the taxes and the incentives. So let's break down the incentive package first. The state put together a $100 million package, $50 million in Pennsylvania EDGE credits, $25 million in Pennsylvania Sites infrastructure grants, and $25 million in Pennsylvania First grants, and also $5 million to the local community college for workforce training. The local township, which is Upper Macungie, approved a LERTA district, which will abate property tax on the new construction for 10 years on a declining schedule starting at 100% abatement. Now this leads us to our next point. The LERTA only applies to the real property Lilly is constructing. So this means the physical building, the 925,000 square feet. Of the $3.5 billion investment, the vast majority will be high-tech equipment and machinery, fill finish lines, isolators, process piping, clean room systems. Pennsylvania is one of 14 states that does not levy property tax on business personal property. This means any new equipment Lilly puts at this factory, whether right after construction or in 20 years from now, will not be subject to property tax. This is what I would call a silent incentive, meaning it may not show up in the press release or in the incentive package paperwork, but it's a big influence on Lilly's decision to choose Pennsylvania. Let's calculate property taxes on equipment if Lilly were to put this exact facility in Dallas, where manufacturers indirectly fund high school football stadiums. For our thought experiment, let's assume the investment split is $1 billion into the building and $2.5 billion into the equipment. In Dallas, the effective property tax rate is 2.23%, meaning Lilly would owe roughly $282 million in business personal property tax on that equipment over the course of 10 years. In Pennsylvania, it's zero. Now, cities in Texas will usually abate a portion of these property taxes, but usually only for about 10 years. In Pennsylvania, any future equipment purchases won't increase Lilly's tax bill. Lilly is one of many life sciences companies announcing projects in Pennsylvania lately. And this is all by design. As I mentioned earlier, the Pennsylvania EDGE program has a dedicated biomedical manufacturing tier. Pennsylvania also has one of the better research and development programs among states, which is part of the reason Lilly itself announced last November to open a research lab in Philadelphia. Now, I personally think this is a steal for the Lehigh Valley. These large pharmaceutical plants will typically have research capacity either in the facility or directly nearby, which means the region needs to have ample engineers, scientists, and universities churning out more of these professions. I already mentioned that Lilly recently announced a new lab in Philadelphia, which is probably why they're willing and able to manufacture in a little bit of a smaller market. If you work in finance or real estate and want to compare taxes and incentives for your own company or client's next project, go to my calculator and run the numbers for free.